will tell you a bit about myself and continue what we will do today. Okay, now a bit about myself. My name is Manvi, and in these videos I will discuss various topics related to finance. If you guys do not want to miss out, please hit that notification bell. Enough about myself. Let's get started. Agenda. So today we're going to be talking about assets, liabilities, and cash flow patterns. They're just 3 things. It will be really simple. Come on, trust me. Let's start with assets. The definition of an asset is a resource with economic value that one controls with the expectation that it will provide a future benefit. This basically means that it has an economic value and people expect a benefit out of it, whether it's intellectual property, physical property, which is basically money. So, let's give you some examples. So, an example of intellectual property is copyrights, patents, and trade secrets. Now for the key takeaways. An asset is a resource that is expected to provide a future benefit to whoever owns it. I just told you the definition of that. It basically means, again, it'll give you a benefit. An asset may generate cash flow, reduce expenses, and it can either be tangible, like a piece of machinery, or intangible, like a copyright. For accounting purposes, assets are classified as current, fixed, financial, or intangible. We'll talk about this more in our future videos. Next, liabilities. A liability is something that a person or company owes, usually a sum of money. A liability is generally something that's owed to someone else, sometimes a debt. Liabilities are settled over time through the transfer of economic benefits, including money, goods, or services. Key takeaways. Liability can also mean a legal risk or obligation. Now you may ask me, Manvi, what does a legal risk or obligation mean? Instead of searching it up, let me just tell you. So, a legal risk or obligation means that it's the possibility of reputational or financial loss, which means you're basically losing your reputation or you're going to lose your financial money. So, they're both bad things to lose, but if you were not buying liabilities, you will never face the situation. Let's go on with the key takeaways. Companies book liabilities in opposition to assets. And then finally, long-term liabilities are listed on the balance sheets as obligations but are not due for more than a year, which means they're listed but they're not due. Okay, examples. They can be taxes, mortgage, business loans, and etc. So let's go on to our final thing that we're going to learn today. Cash flows. Okay, the definition of a cash flow is the total amount of money being transferred into and out of a business, especially as affecting liquidity. This is a chart of cash flows of an asset and liability. This is a cash flow of a liability, and this is a cash flow of an asset. As I explain this, you might think, what's the difference? Yes, there is a difference, a clear one. If you buy an asset, it's going to help you get more money into your pocket, as it says, that has the arrow points to income. But if you buy a liability, you're going to start with buying liabilities and go directly to expenses and out the hole. No money into your pocket at all. So buy assets, guys, not liabilities. Okay, now for my citations. These are the citations I used. I used Robert Kiyosaki's book, Rich Dad, Poor Dad, from a best-selling author and the best-selling book from New York, Tech Press Inc. in the 2000s. And then citation number 2 is, these are a few websites that I used for the definitions of assets and liabilities and how to explain them. Thank you so much for using your time today and listening to me. Please hit that subscribe button and hit that notification bell, and I'll see you in my next video. Goodbye.